Welcome back. This is Dr. Ralph Viator again. And in session two, we begin an introduction to CVP, cost, volume, profit analysis. This is a key fundamental tool used by managers and managerial accountants to make very important decisions. If you haven't done so, I strongly recommend watching the video on cost, volume, profit analysis. It's about a company by the name of Store 24, and the video provides very real-world examples of how that company has used CVP, cost, volume, profit analysis, to make key managerial decisions. For example, they were getting competition from Starbucks, and they had to decide whether to invest in machines that would enable them to make and sell high-end coffees. You can see they decided not to pursue that based on their cost, volume, profit analysis. They also looked at their daily operations and asked themselves, well, are we better off continuing the deli or shutting the deli down, buying the sandwiches pre-made from a vendor and selling them, still having sandwiches available, but using much smaller floor space. Very interesting practical example in that video. Strongly encourage you to watch it. As we move into cost, volume, profit analysis, we start thinking about the difference between something called absorption costing versus variable costing. We'll start with the numbers on the left-hand side of the screen. This is an example of absorption costing. Essentially, absorption costing is what is used in financial statements that are reported to shareholders, to other stakeholders like banks, lending institutions. It's generally accepted accounting principles for financial reporting. So as a quick review, you can see that we have revenues, let's say of $1,000, and next we show the cost of a product sold, or for a service company, we can show the cost of services provided. These costs are going to include variable costs, as we talked about in the last session. We can have variable manufacturing costs like direct materials, direct labor, variable overheads such as electricity, and fixed costs, rent on our production facilities, salaries paid to engineers. In this case, it totals $410. And when we subtract that from revenues, we get gross profit, a key figure reported in financial statements. Below that, we have all other expenses. These are period expenses. Accountants report these expenses in the year and the month that they occur. So we have marketing expenses, other administrative costs. Some of these are going to be variable. An easy example is sales commissions. Higher level sales, higher level of sales commissions. But some of them are going to be fixed. Certainly, there are salaries in marketing and administration that are fixed. Also, rent on corporate headquarters. This has nothing to do with production, therefore it's not reported in cost of goods sold. It's expense each period. When we subtract period expenses from gross profit, we arrive at operating income. Now, what we do on the right-hand side is to rearrange those costs, grouping all variable costs above the decision line, and then all fixed costs below that. This format is not acceptable for reporting to external stakeholders, shareholders, and lending institutions, simply because it does not match costs incurred with revenues produced. In this example, we do arrive at the same operating income, but we arrive at the same operating income only because inventories did not change. We have the same level of inventory from one period to the next. We'll discuss that more later. So on variable costing, we see the same revenues of $1,000, and then all variable costs, variable product cost, $250, but also variable marketing costs, such as a sales commission. When we subtract all variable costs from revenues, we arrive at something we identify as the contribution margin. That is the amount of monies available to cover fixed costs, such as fixed product costs like rent and depreciation on manufacturing facilities, and fixed marketing costs, salaries, and rent at corporate headquarters. The contribution margin is the amount available to cover those fixed costs. This slide is a summary of what I just described, but just very quickly, it demonstrates two dimensions. The columns show variable cost and fixed cost. The rows show two different types of cost, production cost, and then selling and administrative cost. From a variable costing perspective, we are concerned about identifying all variable costs, the production variable costs, and the selling administrative variable cost. It allows us to calculate the contribution margin, which is sales minus all those variable costs. And then separately, we identify fixed costs, fixed production costs, and fixed selling cost. All right, so here's the basic layout for cost volume profit analysis. Notice in this example, the selling price for our product is $1.50 per unit. The total variable cost, which could certainly include production costs such as direct materials, direct labor, variable overhead like electricity, but also variable selling costs such as sales commissions. We subtract all those variable costs from the selling price per unit and arrive at the selling price less variable costs, or the contribution margin per unit, in this case 30 cents per unit. Now, we're concerned about covering our monthly expenses, rent of $3,000, salaries of $13,500, other fixed expenses. It could be production fixed expenses or marketing fixed expenses of $1,500. Total fixed expenses of $18,000 a month. Hopefully you see the issue here, and the issue is, given that we have fixed expenses of $18,000 and we're earning only 30 cents per unit, how many units must we sell to first cover those fixed expenses? Because we must cover them first before we get to profit. Within the relevant range is essentially a important note that the analysis we're going to be performing only works within a specific range of activity. So the relevant range is the range of activity, number of units sold, number of jobs performed, number of service engagements, where the relationship between cost and activities is stable. It does not change. Primarily, we note that within the relevant range, fixed costs are constant. Okay, so you can think of it this way. Let's look at the next slide. Let's say our relevant range right now is we're producing between 40 and 80,000 units. Now, if we were to scale back on production, dropping down anywhere from 0 to 40,000 units, we would have a lower fixed cost. On the left-hand side of the graph, it shows $60,000 in total fixed cost. But we do that by eliminating some of our production capacity, shutting down production units, laying off salaried people, would put us at a lower fixed cost, a different relevant range. Same thing applies when business is expanding. We want to increase overall revenue. We can do that by adding another production facility. That's great, but as we add the additional production facility, we move into a different relevant range, and fixed costs are higher. In this case, 115,000. So it's important to keep in mind that the analysis we're performing, by definition, must be considered within a specific range where fixed costs are stable, not changing, but also the variable cost per units are stable. All right, here's a slide that looks complex, but it certainly is not complex. Just take it one step at a time. Hopefully you recognize it from the previous session. Look at the dashed line at the bottom. That shows fixed expenses, and we said fixed expenses were $18,000 within this particular range of outcomes from 0 units up to 100,000 units. And we also said that we could identify the total cost as being a minimum of 18,000, but increasing steadily from that point. You see the line marked total expenses, increasing steadily as production increases, production and sales increase. What's been added to this analysis is the revenue line, or is noted in this slide as sales. At the very bottom of the graph, at 0 units produced and sold, clearly revenue is 0. But from that point forward, for each additional unit produced and sold, we have total sales increases, total revenue increases. The key point here is that there's an intersection eventually where revenue crosses the total cost function. Below that point, and that point is called the break-even point. Below that point, the company is in a net loss position. Total revenues is less than total cost. But above that point, total revenues are greater than total costs. Above that point, we've covered the fixed cost and the variable costs up to that point. When we move beyond the break-even point, for each unit sold, assuming that the selling price per unit is greater than the variable cost per unit, we're making a profit. And at that point, we no longer have to worry about fixed expenses. Being able to calculate the break-even point is a fundamental question that every business person asks himself or herself. How many units do I have to sell? Or if you're providing services, how many engagements do I have to complete before I cover my fixed costs? Literally, you can start the beginning of the month knowing that, oh my gosh, I have salaries to pay, I have rent to pay, I have a loan at the bank that needs paying. On day one, in the beginning of the morning, there is no revenue, and yet those fixed expenses are staring at us. So how many units do we have to sell? How many engagements do we have to engage in before we cover our fixed costs and move into a positive profit condition? We'll look at the details in the next session.